Hi, everyone, and welcome back to the show. Thank you for joining us. I hope that we can provide some value to you in the next 20 to 25 minutes. Hopefully, everyone had a great Halloween, enjoyed their costumes, got some great trick-or-treating with family and friends, and saw some cool costumes. It's November 1st. Welcome to November. Hopefully, November will treat us better than October did in terms of the markets. But let's talk about what's going on right now. What do we need to be focused on? What are those hot topics that are going to affect the financial decision making that we have in our own households? And so the thing I'm going to continue is, yesterday we talked a little bit about the Fed and the interest rates, and that interest rate remaining high, but not increasing right now, even though they are projecting another rate increase between now and January. But how are those interest rates affecting everyday lives of all of us and our decision making in what purchases we're making, and how has it become more imperative for us to see the opportunities of a higher interest rate environment to make sure that we are capitalizing on the potential opportunities. And those home values are increasing at a slower pace because of factors that are contributing to people not being able to afford the same home that they may have been able to afford 6, 12, 18 months ago. And so when you look at these higher interest rates, it's increasing the mortgage payment. So the amount of money that people are putting down generally stays the same. You would find that if people had the accessible liquidity, that they would put down a little bit more in higher interest rate environments to try and drop that mortgage payment. But in a number of cases, meaning majority of those cases is what I meant to say, people have a fixed amount that they're going to put down on their house, on their next purchase. I'm going to put this amount down, and then that's going to fall where it may. I have a budget that I can afford, and basically it becomes an equation of what can I purchase. Well, when interest rates go higher, then the mortgage payments also go higher. So now the value of the home that I can afford is obviously lower. So I may have been looking at, let's say, a $750,000 house, and now I'm dropping that down to a $650,000 house or a $600,000 house in order to make those numbers still work. And so when that happens, you're having less people that can afford that same house, which is reducing competition, and that's also affecting the seller's market right now, and you're seeing more sellers that are a little bit more flexible with their terms and with their pricing than they have been over the last 2 years, where we've seen a lot of competition. Just 2 years ago, we had low interest rate environment where people could afford to buy a larger house or a more highly valued house and still be able to afford that mortgage payment. Now that that's changing, obviously, we're seeing the speed in which, or the rate in which those housing prices are increasing, we're seeing that fall. So if we look at some data here, some statistics, let's take a look at the Mortgage Brokers Association. So the Mortgage Brokers Association has an index called the Mortgage Credit Availability Index, and it fell to its lowest level since 2013. And so that is kind of measuring the availability of credit. How are lenders tightening their credit requirements, or for borrowers to be approved for said loans? And so we're seeing a tightening of that credit, which is also creating another hindrance on the real estate market. So you're going to start to see those purchases of homes being by more qualified buyers with more money and liquidity down, and overall they're in a better financial situation, and those are the people that are going to be getting approved for those jumbo loans and those mortgages as we see lenders continue to tighten their requirements. In addition to that, you also have the home equity line of credit. So the American Bankers Association reported that 43% of the lenders said that they are tightening their home equity line of credit requirements. And so you're also seeing the availability of people to have access to cash liquidity from their homes. And that has a huge impact on the velocity of money and homeowners being able to access those funds to invest in more properties, or to even do capital improvements on that property. So that is obviously going to bring a little bit of a reduction to that overall market. Now, when we talk about the tightening of credit, we also have to look at this not in a bubble, but we have to look at the entire atmosphere as much as we can. There's a lot of factors here. And when we talked a little bit about yesterday about inflation and how that is affecting individuals and their decision making regarding their finances, that's also having an effect on what people are getting approved for on their mortgages. So for instance, if all of the other costs of goods are going up to run your household, energy costs are higher than they've been, it's insane. Grocery bills are higher than they've been. And we've seen an overall inflation of retail and consumer goods. So it's actually costing you more to just live and to do all the things that you normally do. So the banks are also looking at those expenditures in your household monthly expenses and then taking that into consideration on your ability to repay that payment. So that's not to say that you shouldn't buy a house right now. That's not to say you shouldn't go get a mortgage. It is only to look at, even if you're not currently in the market right now, how is that having an overall effect on our economy? Are people going to start feeling less wealthy because either their home values are coming down, or because they can't access the cash, or because the monthly mortgage payments are higher and so is everything else around it? So when you look at all of those factors, if people start to feel poor, then as we head into the end of the year, we could potentially see some retail numbers that aren't going to look very good. And it's going to push, I believe, a large percentage of the population into believing that we are heading into a recession, which a lot of indicators say that we are. I'm not really a doomsday guy from the perspective that I think a lot of the things that are going on right now are in isolated, unique situations that may be able to be greatly improved upon with different policy changes and also different things around the world maybe being resolved. So we have to remain hopeful, but still cautious and observant. And I apologize for my voice. I can't get it under control and it's a little raspy today. Okay, so with all of that going on and with all of those factors being in play, what are the opportunities? It seems like it's all negative, Jim. Where can I find the opportunities? Well, for those of you who are looking at investments and looking at this opportunity to say, okay, where can I put my money? What are the smart money decisions that I can make right now that are either a 3 to 5 year window or even a 10 to 15 year window? And there's a lot of options out there right now because of the higher interest rate environment. So for instance, if you take a bank account which has a couple $100,000 in it, you're covered by FDIC insurance up to that amount. So you kind of have some guarantees there. But now, when that money is now sitting in a brokerage account rather than in an FDIC insured checking, savings, money market type account, and it's now in a brokerage account being managed by a financial advisor, those are the questions that I think people are really struggling with right now. And what do I do with my money? What is the smart move? And really, it comes down to, it's a very difficult and challenging situation for the financial advisor. And what I mean by that, I am not a stockbroker. I am not a wealth manager. I voluntarily gave up my Series 7 and 66, so I do not manage money. I do not have the licenses to manage money or to manage assets in publicly traded things. That is not me. I have absolutely no interest in going back to doing that. But because I have that background, it also allows me to look at it from their point of view and have an understanding of some of the challenges that they're facing right now in providing their service to their clients. And that challenge is, if I can go out and get 5%, 5.3, 5.25, 5.4, 5.5, somewhere in that neighborhood with an A-rated company, either with an annuity or with a potential CD that I could purchase, or there might even be some retail banking investments out there that are offered by your bank that may be offering very similar rates of return. That is a very difficult challenge for a wealth manager who now has that as a benchmark. Because if I can go out and get 5% rate of return on my money at no risk, or at very, very, very minimal risk, well, now that becomes a challenge for me when I'm talking to my financial advisor, and that individual is going to try and go out and get 6.5%, 7%. I mean, obviously they would love to get you more, but it becomes a challenge of how much risk am I willing to take on to get that additional 2, 3, or 4%. There is a lot to be said for leveraging your dollar right now with financial institutions that are going to provide you a lot of guarantees, provide you the rate of return that you're looking for, and be able to have absolutely no downside risk. So what I mean by that is, let's say, for instance, just for example, we choose an annuity, and we are weighing the options of whether or not to leave that money managed by a financial advisor or move that over into an annuity. Well, when you're managing it by a financial advisor, that financial advisor has the potential to go out and get you 20% rate of return that year. That is something that is not available to you in the annuity. Very, very, very few. We could talk about variable annuities, but keep staying away from that and staying away from anything that would have any potential risk in the market. Let's focus on either a fixed annuity or an indexed annuity, and we can get into more detail at a later session regarding what are those products and what are the differences between the two. Look back at the old archives of the Gannon Wealth Security Partner videos, because we went through annuities and their advantages and disadvantages and how they all work together. But we'll do more and do refreshers on what products are available now and how the interest rates are affecting that. But let's just say that you turned around and you decided that you were going to move all or a portion of that money that's in your brokerage account, and we move it over to the annuity. Well, the annuity is going to guarantee you a rate of return for a specified period of time. That might be 5 years, 6 years, 7 years, 10 years. Okay, and they're going to guarantee that minimum rate of return for you on that money. Now, there's nothing stopping you from taking that money that you're making on the interest and then reinvesting it into other vehicles that may have more risk. But the difficulty here is, why am I going to potentially, yes, I can get a financial advisor to get me a 20% rate of return in a given year. Is that repeatable on a regular basis? I don't think so. Others may argue to the contrary, but I think it's a very, very difficult challenge to get that rate of return over and over and over again. So what that means is when I'm chasing that 20% rate of return, I also have a significant chance of losses. And if I'm taking on that risk of losses, that's the difficulty and the challenge for the financial advisors, because they have the fiduciary responsibility, the goal, right, to manage your money prudently to go out and get the rate of return that you're seeking to get. The challenge there is they're putting your money at risk in order to do it. So the financial advisor is making decisions that can potentially make you money or potentially lose money, where the annuity is a no-frills guarantee that you would be able to say, during this period of time, if you're going to guarantee me a rate of 5%, I'm going to go out and take it because I have absolutely no risk. I don't have to worry about it. I don't have to concern myself with it. And if I enjoy investing in the market, and again, I am not telling you not to invest in the market over a long period of time is going to far exceed most annuities. Caveat to that is what time period and years are you taking? Because if you lose 40 or 30 or 50% in the final 2 years of your snapshot, those numbers are not going to look very good. But over a long period of time, if you're young, if you still have 20, 25 years of work ahead of you, then you have the time horizon to make up for many shortfalls, and the market may be your best option. But the best solution may be a combination of both. And see, if I have my money in the brokerage account being managed by the financial advisor, and I like the financial advisor, he or she, great person, fantastic. We like them, very comfortable with them, but I'm putting my money at risk in order for them to get me a rate of return. What if I turned around and took half of that money, put it into an annuity, guaranteed myself a rate of return of somewhere around 5%, and then told the financial advisor with the remaining money, now I can be a little bit more risky. Now I can go out and maybe chase a rate of return because I'm guaranteed to get some rate of return over here. And so you might want a blended way of handling that situation depending on what your objectives are. There are a lot of people out there right now, and many of my clients, now that may be a gravitational pull, right? So let's call that what it is. People gravitating to me who are more opposed to taking risk. And because the products that I'm providing are guaranteed products, so that I might be attracting kind of, but neither here nor there, the clients that I work with a lot of times will say, I'll go make my money in my craft, in my field, in my profession, in my company. I'll go make my income and the money that I need in order to support my lifestyle that way. I want the money that's working for me to be stable, to be growing, and that if the market loses 30 or 40% that year, I don't lose a dime. It watermarks, and if that was my account balance starting last year, at the beginning of this year, and the market did nothing, then I lose no money, and I'm ready for next year at the same level as I was to start the year. I made no money, but I lost none, and then hopefully I'm hoping that the market rebounds and responds, and that I can now, without ever having lost any money, I stay here, but I can participate in that recovery. And so that is a very important framework for you, for your family, for how you're going to make those financial decisions and how you're going to evaluate what risk you want to take. And so on one side of the high interest rate environment, we can certainly look at it and go, it's so much more expensive to buy the house. I wanted that house. I could have afforded it 8 months ago, but now interest rates are too high and I can't afford it. That's bumped down. Or inflation is high and now my overall living expenses are higher, so that's less money that I can put towards a mortgage payment comfortably. If all of those things are going through your head, you're not wrong. You are aware of the current situation. That's all great. But you also have to be aware of all the opportunities that are out there due to that high interest rate environment. It becomes imperative in high interest rate, high inflation environments that we invest in appreciating assets. Now is not the time to be spending your money frivolously on vacations or depreciating assets like vehicles, cars. Those are things that I'm not saying you can't go out. If you can afford it, go out and do it. I am not one to tell anybody else what they can or cannot afford. However, if you're in a situation where you're starting to look at your budget and you're starting to get a little bit more nervous about how it looks, then you want to put a plan together and remain focused on how am I going to get my money in appreciating assets, and hopefully I can even do that with taking on very little risk. So November 1st, 2023, we're getting into November. Hopefully it's a great month for you. We'll stay with you to kind of talk about the current events that are going to continue to happen and how those events are going to affect the financial decisions that you make on behalf of you, your family, your business, and your financial future. Thanks so much for joining us. We always love to have you. My name is Jim. You can reach me at jim@gannonwsp.com. Please send me an email. Tell me you love it. Tell me you hate it. Tell me what you want me to go over. Tell me what you're concerned about now, because essentially what I'm trying to do is bring the 30,000-foot view conversations that I'm having with my clients, bring them right into your phone, your laptop, your computer, your tablet, whatever you're watching this on right now. Bring it directly to you so that you can kind of start to think about some of the things that people are considering, and maybe that has a positive impact on your own financial decisions. Thanks again. I'll talk to you soon.